When it comes to capital gains tax here in Australia, there's a lot of lies and misconceptions floating around that I hear all the time from investors. And these things are costing people stacks of money in tax that they don't need to pay. And if you're wanting to become a high performance investor, tax is not an area you can ignore, because you can get great at all the things like identifying good companies, finding opportunities, making big capital gains. But then if you make a stupid move and end up paying out tons of tax when you don't need to, you end up giving away all that gain anyway. These three things I'm going to talk about are the three biggest lies people tell you about capital gains tax and how you can fix them to become a more tax efficient investor. Let's get into it. The first big lie you might have heard already is that FIFO is the only strategy you can use for calculating capital gains tax. Now, as my unique position as a founder of a tax reporting platform called Navexa, I get to hear from customers all the time. And I've heard this from individual customers, I've heard this from accountants, I've seen this on Reddit, I've seen it in forums. So many people think that FIFO is the only way. Now, if you don't know, FIFO stands for first in, first out, and it's a capital gains strategy for how you calculate your capital gains. Now, one of the good things about the ATO is that they are very flexible here in Australia, and basically as long as you can prove how you calculated the capital gain, they don't mind which strategy you use. So instead of just using FIFO, which is first in, first out, you can use things like LIFO, minimize gain, maximize gain, even manual parcel selection where you choose the parcels individually yourself. I've got some awesome videos you should check out, link in the description, on how those other strategies work. And I go through some trivial examples and some non-trivial examples as well of how to calculate those things. But depending on which strategy you use, you can, with the same sale of shares, end up with a capital gain, which you end up paying tax on, or you can even end up with a capital loss from the same sale of shares. And that's why choosing the right CGT strategy for what you're trying to achieve is super important and can save you thousands, if not tens of thousands of dollars, depending on the size of the trade you're doing. Let me show you really quick in Navexa the difference between running a FIFO strategy and a minimized gain strategy, and you can see the impact it has on the capital gain that's calculated. So let's take a look at this BHP holding here, and you'll see that there was a buy trade back in 2000, and then a bunch of dividend reinvestments over a few years before there was eventually a sell trade. Now, depending on what strategy you run, you're selling 500, you originally bought 500. If you're running a FIFO, it'll sell this first because it's first in, first out. But if you're running a LIFO or a min gain, it's going to sell some of these other ones first. So if we jump into the capital gains tax report, you can see this in action. So you can see here a couple of BHP records. You can ignore all these other shares for now. They're just other shares in the portfolio. Overall, the capital gain calculated is 19,100, mostly using a FIFO strategy. If we change to a minimized gain strategy and update, our 19,000 has now become 13,000. Big difference. That's 6,000-ish less dollars that you're paying tax on. And you can see now that there's plenty more BHP records because it's going through all of those smaller dividend reinvestment parcels first before doing the main one, which was part of the FIFO strategy. So changing strategies can have a massive impact. There's a great example. Now, the second biggest lie I hear, and again, I've heard this from accountants, I've seen this on forums, I've seen it on Reddit, and that is that you can, once you've chosen a CGT strategy, that you're locked in for life. So if you started with FIFO, you can only use FIFO from now on. That is just simply incorrect. As I explained in point 1, the ATO don't mind how you calculate capital gains tax as long as you can prove how you did it. So that means for 1 year you can run FIFO, the next year you might run LIFO, the year after that you might run minimized gain. And then from then on, you might run maximized gain. The choice is absolutely up to you. And even within that, you can run different strategies on each individual stock or crypto within your portfolio. So while your overall portfolio might be running a FIFO strategy, you might be running the minimized gain strategy on a particular stock that you have in your portfolio. All of these things are absolutely allowed and legal and can save you a massive amount of tax when you don't need to pay it. Now, as always, I've saved the biggest one for last, and that is number 3, which is that your previous financial year tax reports don't matter when you're doing your current year's financial tax year report. Now, not only is that incorrect, but that can land you in legal trouble with the ATO because you'll end up filing your tax return incorrectly. Let me show you an example. So imagine this timeline across here. And say 5 years ago, we bought 5 shares. And then a couple of months later, say we bought another parcel of 5 shares. Let's look at the previous tax year to the current one. So these are buys, we'll give them a B. Then last financial year, we made a sale of 5 shares. That's an S, sale. So if we're using the FIFO tax strategy, that means that when we did the 22-23 financial year, this capital gain was calculated on these ones, first in, first out. Now, let's fast forward to the current financial year, the 23-24 year. Let's say we sold 5 here. Give it an S here. If you've been keeping records and you run the FIFO strategy, you're going to see, well, I can't sell these shares because they were already sold in this financial year. So this one is going to sell these shares. No problem. You ran the FIFO strategy and successfully calculated everything. Now, if we get rid of these, and let's look at an example of what a lot of investors are doing and not realizing, is that last financial year, they sold 5 shares and they ran FIFO and correctly sold the first parcel, right? Now, they didn't keep any records of that. The next financial year comes along and they make another sale of 5 shares. What ends up happening is they run the FIFO strategy, but they sell this parcel again. Now that's a big problem because this will likely be a different capital gain. I should have said, put a price on here. So say we bought 5 shares at $1 and this one was 5 shares at $2. The capital gain is going to be very different depending on how you calculated that. So you've ended up double selling that. So in fact, when you file your capital gains tax return for this current year, you've got incorrect numbers and you're filing an incorrect return. Now this example is a trivial example because you go, I can see like I sold here and bought there. But think of examples like you've dollar cost averaged into a stock or ETF for 5 years and you have 60 transactions and you've made a few sales in that time. If you haven't been keeping the record, you're going to end up double selling every time. And we see this all the time in Navexa. People come along, they sign up for a month and do a tax report, but they don't go and update all the previous settings they used in the other financial years. So when they run this year's tax report and file it, they've often double sold things that they've already reported, which is why it's important to keep records throughout the years, particularly if you're changing CGT strategies through the financial years. Because if you have multiple parcels of this particular stock, one year you might run LIFO, which will sell the last in, first out, and then the next year you sell FIFO, and in this trivial example that's not a problem because there's only 2 parcels and 2 sells. But imagine if you had 30 buy transactions because you're dollar cost averaging, or maybe you're just an active trader. That's when it becomes super critical to be tracking the different CGT strategies for each financial year so that you don't double sell things. And that's exactly where a tool like Navexa solves that problem for you, so you never have to think about it again. So there's many different aspects to capital gains tax here in Australia, and it is up to you as an investor who's trying to be a high performance investor to fully understand how these things work. Now, while capital gains tax can be complicated, it's not actually that complicated. And if you learn some of these things like CGT strategies, learning about the CGT discount period, learning about manual parcel selection and advanced tax strategies, you can make some very tax efficient trades when you're investing. And that means more of your hard-earned gains go back into your pocket instead of you paying them out to the ATO. If you like this content, please like the video. Really helps the YouTube algorithm for us. And make sure you subscribe if you haven't already. I'm going to be publishing videos like this at least once a week with how-tos on tax. We're going to talk about performance tracking, and we've got a few other exciting things coming your way soon. So make sure you like and subscribe for those things, and I will see you in the next video.